US stocks rally as the Treasury Secretary says the US-China trade conflict is unsustainable. But surveys indicate weaker US economic activity in April due to heightened uncertainty because of all these tariff moves. That's coming up in our 5 Things in 5 Minutes on Wednesday, April the 23rd. And then in our bonus deep dive interview, ANZ Chief Economist for Southeast Asia and India, Sanjay Mathur, analyses the key factors set to slow growth across Asia's economies after the tariff shock.
We are expecting that across the region, the rate-cutting cycle or its depth would be enhanced by this kind of shock. But the broader question to us, and which is still hard to answer, is are these really going to be effective?
But first, in 5 and 5 with ANZ, US stocks and the US dollar rallied overnight as US Treasury Secretary Scott Bessent said the trade conflict between the US and China was unsustainable and he expected it to de-escalate. At 4 a.m. Sydney Melbourne time, the S&P 500 was up 1.5% and the Nasdaq up 1.8%. The yield on the 10-year US Treasury yield was down 1 basis point. ANZ head of G3 Economics Brian Martin says the rally was also supported by traders, re-evaluating the pressure being put on Federal Reserve Chair Jerome Powell by President Donald Trump.
I think the market is of the view that President Trump is trying to pressure the FOMC chairman into reducing interest rates rather than trying to remove him as chair of the FOMC, particularly given that US Treasury Secretary Bessent has said that Fed independence is a real jewel as far as economic policy is concerned. It's also the case that there are 12 voting members on the FOMC, so 12 people actually decide interest rate settings. So it would take more than removing the chairman of the Fed in order to really compromise policy settings from the FOMC.
As of 4 a.m. Sydney Melbourne time, due to the stronger US dollar, the Aussie dollar was trading down 0.45% at 63.81 US cents, and the Kiwi was down 0.23% at 59.82 US cents. Gold is down 0.4% but hit a new record high earlier in trade of over $3,500 an ounce. More on that later. Number 2. New surveys on US business conditions in April were released overnight, including the Richmond Fed's Manufacturing Index. That was down 9 points to minus 13. The Philadelphia Fed's Non-Manufacturing Activity Index also fell 10.2 points to minus 42.7. Here's Brian again.
That was the lowest reading since the pandemic, and before then since 2011. So it shows the economy is really quite weak, and that businesses, not just in the manufacturing sector, but also in the non-manufacturing sector, are quite concerned about the impact that tariffs and broader economic policy settings are going to have on economic activity.
Number 3, the US dollar index was up 0.4% at 98.74 at 4 a.m. Sydney Melbourne time, off the back of those Bessent trade comments, but it's still down more than 10% from 110.18 in mid-January. ANZ Group Chief Economist Richard Getzinger says there is potential for the dollar to come under further pressure.
At the end of the day, the US dollar is a deficit currency. Up until 2 months ago, it was trading at its highest level in real terms since 1985 against a broad basket of other exchange rates. Against some of those exchange rates, it's still close to those levels. Even, the euro and some of the other European currencies have started to undo some of that dollar overvaluation. And we have a chaotic approach to policy coming out of the US administration. I see downside for US asset markets and I see downside for the dollar while this approach to policy continues. Even if we walk back from the worst of tariffs and the worst of this difficult situation with the Fed, it seems highly likely we still be left with a policy process in the US which saps confidence, saps certainty, and erodes US exceptionalism.
Number 4. The gold price retreated after hitting new record highs above $3,500 an ounce overnight, trading down 0.4% at $3,411 an ounce as of 4 a.m. Sydney Melbourne time. ANZ commodity strategist Sunny Kamari says there are a number of factors which could temper the recent rally.
The accelerated pace of gold price rise could trigger a profit booking, which will provide a breather to current gold price rise. There are downside risks to higher gold prices, a de-escalation in the US-China trade war, quicker resolution of trade concerns with other trading partners, and improvement in the US economic outlook. Higher interest rates than market expectation may impede the price rally.
Number 5. Amid the US-China trade conflict, a key question is when Chinese authorities might cut interest rates to support their domestic economy. Earlier this week, key 1- and 5-year loan prime rates were left unchanged. ANZ senior China strategist Zhao Pengxing says strong first quarter growth data has reduced the need to cut rates immediately.
Under the current policy framework, the market expects the PBOC to cut 7-day reverse repo, the policy rate first, not the LPR. So with strong Q1 GDP data, we expect the PBOC to delay the policy rate cut to the end of Q2 or the early Q3. LPR cut will be delayed as well.
Xiaopeng Jing there. Now, in our bonus deep dive interview, ANZ Research downgraded its forecast for Asia ex-China growth prospects yesterday. ANZ Chief Economist for Southeast Asia and India, Sanjay Mathur, spoke to my colleague Alex Tarrant about how the US tariff moves at the start of April are likely to affect Asian economies.
There are quite a few sort of developments that we have to take, or potential developments we have to keep in mind for Asia ex-China. The first is the direct impact of slowing global trade. The second is the heightened economic uncertainty that will put corporates in the back foot when it comes to investment decisions. The third is that there will be a slowdown as far as US growth is concerned as well, and we have downgraded our US growth forecast. And finally, what we cannot ignore is the fact that we will see greater penetration by Chinese exporters into Asian markets, because if the US becomes harder and harder, it's a market to sort of grow in. So all these factors will culminate into slower growth in the region.
And then you've also looked at the inflationary impacts or the disinflationary impacts of current policy settings. Talk us through, obviously looking at inflation in the US, but disinflation across Asia. Talk us through the extent to which you see that and whether that will be uniform across all economies or some might be affected more than others.
So to start with, Asia never really had any form of demand-driven inflation to start with. It was really a supply-side issue right from 2022. Now what will happen is that if you are going to get exports from China which are cheaper, that would be a source of disinflation. The second is we will obviously generate a fair amount of economic slack, and that means that producers will not be able to sort of have the same pricing power or retain the same pricing power as they had prior to the imposition of tariffs. This will eventually sort of feed through manufacturing sector incomes, wages, and that in turn reinforces the disinflationary cycle. Now, of course, the more open as an economy you are, the more or the greater will be the impact, if you like. Some of the economies, though, like India, for example, their inflation may not come down drastically. The reason being that food prices have been a material driver of inflation over the last few years. But India is few and far between when it comes to the broader region in terms of inflation dynamics.
China's potential policy response, and people are expecting rate cuts there. What else could we see across the rest of the region? Again, will it be uniform rate cuts, or are you expecting different policy responses in different economies?
We are expecting that across the region, the rate cutting cycle or its depth would be enhanced by this kind of shock. So everywhere we can see that we had built in a rate forecast, they would obviously become rate cuts, they would become deeper over a period of time. But the broader question to us, and which is still hard to answer, is are these really going to be effective? Because if consumer confidence, if business confidence becomes lower or falls, then it would also be fair to say that the cost of capital by itself is not going to be a major driver of spending.
Sanjay Mathur there, talking to Alex Tarrant. I'm Bernard Hickey. That was 5 and 5 with ANZ for Wednesday, April the 23rd. Catch you tomorrow with an assessment of how much the global trade turmoil is feeding through into Australian confidence. This podcast contains general information only, not investment advice. You should obtain advice for your personal circumstances before making any investment decisions. Please view the podcast disclaimer available via your media player or email.